Most people overpay their taxes every single year, not because the rules are complicated. It's because nobody ever told them which deductions actually exist. Ever wonder why your neighbor gets back twice your refund on the exact same income? Today, I'll explain the deductions that actually matter like you're 5 years old. By the end, you'll know exactly which ones to check before you file, and which ones have been sitting there unclaimed for years. Quick note, this is legal education, not legal advice. Tax laws change by situation and year, so talk to a tax professional about your specific case. Picture this. It's tax season, and you're already dreading it. You're sitting at your kitchen table with a pile of receipts, a lukewarm coffee, and a spreadsheet that's making you feel slightly sick. You punch in the same numbers you punch in every year. Standard deduction, maybe your mortgage interest, and you're done. The refund comes back smaller than you expected, so you shrug and move on. Meanwhile, your neighbor, same income, same neighborhood, gets back twice what you did. What does she know that you don't? And why does it keep happening? She knows the deductions most people never claim. The ones that are completely legal, IRS-approved, and just never advertised. Here's how the game actually works. The tax code was written by people who assumed you had a team of accountants. So you miss things. And those missed deductions quietly add up into real money every single year. Let's call your neighbor Jamie. And everything I'm about to show you is something Jamie walked right past last April. Before the first deduction, let me show you the mistake that costs people the most, because that's exactly where this story starts. Most people take the standard deduction and stop there. That's not wrong. For a lot of people, it's actually the right move. But the mistake isn't choosing the standard deduction. The mistake is never checking whether itemizing would have been worth more. You can't know unless you look. And most people never actually look. They assume the simpler path is the smarter path, and it's usually not. Home office deduction. That's the first one. Jamie works from home 3 days a week. She has a spare bedroom set up with a desk, a monitor, and a printer, and she never claimed a cent. Here's why that's a costly mistake. If you use part of your home regularly and exclusively for work, and you're self-employed or have a side business, that space is deductible. The IRS gives you 2 ways to calculate it. Simple version. Multiply your office square footage by $5, up to 300 square feet. That's up to $1,500 without keeping a single receipt. Jamie's spare room is 120 square feet. That's $600 she left on the table, just sitting there, unclaimed, year after year. But wait, here's the part that surprises most people. You don't have to own a home to claim this. Renters qualify too. If Jamie pays $2,500 a month in rent and her office is 10% of the apartment, that's $3,000 a year in deductions. From rent she was already paying anyway. Second one, job-related education. Jamie took an online course last spring. $600, directly related to her job. She needed new software skills to stay competitive. She didn't claim it. Didn't even think about it. If you pay for education that maintains or improves skills required in your current job, it's deductible. And this one has a cousin that's even bigger, the lifetime learning credit. That's a credit, not a deduction. A deduction lowers your taxable income. A credit comes straight off your actual tax bill, up to $2,000 a year. Those are very different things. Here's the plot twist. You don't have to be a student to claim it. You don't have to be pursuing a degree. One class, one certificate course, one professional development program. It counts. Most people think this only applies to college kids. It's for anyone learning on the job, which, if you're paying attention, is basically everyone. It's 9 p.m. Jamie closes the laptop and tosses the receipt in the trash without a second thought. That receipt was worth real money. It's in the trash now. Third one, and this is the deduction where the math surprises almost everyone. Medical expenses. Everyone knows you can deduct medical bills, but almost nobody knows the threshold. And the threshold is where most people quietly give up. Here's how it actually works. You can only deduct medical expenses that exceed 7.5% of your adjusted gross income. If Jamie makes $60,000 a year, the first $4,500 in medical costs don't count. Everything above that does. Most years, most people don't hit it. But some years, a surgery, a dental procedure, new glasses, therapy, prescription costs, it adds up fast. And here's what almost nobody claims. Mileage to and from medical appointments. The IRS sets a rate per mile. If you're managing a chronic condition and driving to appointments every 2 weeks, that's hundreds of dollars over a year. Jamie never wrote down a single mile. Not one. A small notebook in the glove compartment would have changed that entirely. Fourth one, Charitable contributions that aren't cash. Jamie donated a bag of clothes to Goodwill in March and didn't claim it. Most people don't. They think, I didn't write a check, so it doesn't count. Wrong. Donated clothing, furniture, electronics, household goods, all deductible at fair market value. The IRS even has a guide for estimating what things are worth. A decent winter coat? About $60. A working laptop? Could be $200. A full bag of clothes? You're looking at $100 to $200 in deductions, easy. Jamie made 3 trips to Goodwill last year and kept 0 receipts. 1 piece of paper per trip, and she would have had $400 to $600 just sitting there. Now here's where it gets counterintuitive. Even if you're taking the standard deduction, even if you're not itemizing at all, there's still a category of charitable giving you can deduct on top of it. If you donate money directly from your IRA, not from your bank account, from your retirement account, those distributions get excluded from your taxable income entirely. It doesn't matter whether you're itemizing. Think of it like a door that exists behind the main door. Nobody tells you it's there. Now you know it's there. 5th one. Student loan interest, even if someone else paid it. This is the one that generates the most disbelief. If your parents paid off your student loans, you can still deduct the interest, up to $2,500 a year. The IRS treats it as if they handed you the money and you paid it yourself. Jamie's parents covered $2,000 of her loan payments last year. That interest? Still deductible on Jamie's return, not her parents'. Hers, the person who technically didn't write the check, still gets the deduction. Most people assume if they didn't pay it, they can't claim it. The law says otherwise. And yes, it's completely legal. So here's where Jamie ends up. Home office, $600. Education expenses, $600. Medical mileage, $340. Goodwill donations, $400. Student loan interest her parents paid, up to $2,500. That's nearly $4,400 in deductions Jamie had last year and never touched. At a 22% tax bracket, that's close to $1,000 she overpaid. $1,000 that left her account and never came back. Not because she cheated herself, but because she didn't know the questions to ask. Here's the part that should make you a little angry. The IRS website has all of this information. It's just buried 6 clicks deep, written in language designed for people who already know what they're looking for. The tax code wasn't designed to help you find money. It was designed by people who assumed someone else would explain it to you. Nobody explained it to you. Until now. Jamie at that kitchen table, punching in the same numbers she always punches. That's not stupidity. That's just not knowing what to look for. Now you do. So here's the question for the comments. Which one of these surprised you most? And do you think the system stays this confusing on purpose? Tell me below. And if you know someone who does their own taxes and has no idea any of this exists, send this to them right now. That might be the most valuable thing you do for them all year.